On the morning of August 1st, 2012, one of the most sophisticated trading firms on Wall Street turned on its computers and lost $460 million in 45 minutes. The firm was Knight Capital Group. They were a central participant in the U.S. financial system, handling roughly 10% of all listed equity trading in the country. The New York Stock Exchange was preparing to launch a new retail liquidity program. To stay competitive in high-speed markets, Knight had to rapidly update its internal software to interact with this incoming change. Their core execution engine was a high-speed router known as SMARS. When a large order came in, SMARS divided the incoming trades across 8 identical server nodes to distribute the workload. Starting in late July, engineers rolled out the new software in stages. But during the deployment, a technician missed the 8th server entirely. 7 servers received the new code. The 8th did not. The new software reused an old trigger flag. On the 7 updated servers, this flag activated the new routing logic. But on the unpatched 8th server, that exact same flag woke up a piece of legacy code called PowerPeg, a function that had been disabled in 2003 but was never actually deleted from the system. By leaving obsolete code resting on a live server and failing to verify the update with a second technician, Knight had built a trap inside its own infrastructure. All they had to do was wait for the market to open. The first signs of structural failure appeared early. At 8:01 a.m., an internal system triggered 97 automated emails warning of a PowerPeg error. These messages were delivered in real time to Knight's personnel, but the firm hadn't designed these specific emails to be treated as critical system alerts, so nobody acted on them. At 9:30 a.m., the opening bell rang. When the first eligible retail requests hit the unpatched 8th server, they triggered the repurposed flag and activated the obsolete PowerPeg code. PowerPeg was originally designed to count the number of shares executed and stop trading when an order was completely filled. But in 2005, Knight had moved that counting function to an entirely different part of the codebase. Without the counter, the server fell into a blind loop. It continuously generated high-frequency trades in response to orders that had already been filled, aggressively buying high and selling low across 154 different stocks. From 212 requests, the server fired 4 million trades, moving nearly 400 million shares. When computer algorithms operate in milliseconds, human observation is too slow to catch mistakes. Without automated safety constraints, the margin between a simple operational glitch and total insolvency vanishes. Inside Knight's control room, engineers watched in confusion as a temporary holding bucket, known as the 33 account, began accruing billions of dollars in unintended financial exposure. Their primary monitoring tool, Keymon, relied entirely on manual human review. It generated no automated alerts and began to severely lag under the immense volume of erroneous trades flooding the network. Crucially, the 33 account was not linked to any firm-wide capital limits. There was no hard-coded kill switch that would automatically block the router from sending new orders once the firm's capital was exhausted. Trying to troubleshoot a live trading environment while losing millions of dollars a minute, the technology team made a guess. They decided to uninstall the new software from the 7 servers that had actually been updated correctly. By rolling back the code, they exposed the old PowerPeg flag on every single machine. Instead of stopping the bleed, they turned a single node error into a systemic collapse. Because the firm lacked a clear incident response protocol, the team was forced to improvise on the fly. Their attempt to resolve a single rogue server escalated the problem into a catastrophic event. The internal governance surrounding the software allowed a known operational risk to enter a live environment, where the attempt to roll back the software expanded the failure from a single server to the entire network. At 10:15 a.m., exactly 45 minutes after the opening bell, staff finally severed the system's connection to the market. By then, Knight Capital had realized a net loss exceeding $460 million. The massive deficit severely depleted the firm's capital. Within days, Knight was forced to accept a $400 million rescue package from a consortium of investors, effectively surrendering control of the company. Less than a year later, the once dominant market maker was absorbed by a rival firm, ending Knight Capital's existence as a standalone entity. The U.S. Securities and Exchange Commission later stepped in, handing down a $12 million penalty for clear violations of market access rules. The SEC's findings were blunt. Knight's risk management controls were not, quote, reasonably designed to prevent the entry of erroneous orders at the critical point immediately before they were submitted to the market. In an environment that rewarded execution speed, the firm viewed the friction of rigorous safety checks as a competitive disadvantage. They built an engine that ran efficiently but lacked the mechanisms to fail safely. Knight Capital demonstrated that in a market built on speed, the most critical software is the safeguard that detects failure and hits the brakes.